Alright, so let's continue. Let's see this recording. Yeah, I think so. Yeah. Okay, let's continue. This is Nathan Smith again, going over the slides from Chapter 1 for Economics and Business in Visalia and North Fresno. We were talking about the theory of the firm, and I wanted to start at the last point here. So, economic theory assumes that the primary goal of managers is to maximize the value of the firm. Okay. Now, in some ways, this is a little bit odd, because you could say, well, why would the manager want to maximize the value of the firm? Shouldn't he just want to maximize his own income, or maybe his own leisure? So in a way, this is actually kind of an ideal case that the manager wants to maximize the value of the firm. But what does that mean? And this is the first big scary-looking mathematical expression in the course, and I think it's actually one of the hardest altogether. Probably not the hardest, but from my perspective, this is a very simple calculation, but it tends to elude people. And I hope you can not just memorize the formula, but hopefully actually understand the intuition, because then you will maybe not even need to memorize the formula, because it'll just be obvious what the present value would be. Okay, so let's go over this. Present value of all expected future profits. Future profits are pi 1, pi 2, plus up to pi n, so there's an assumption that you're looking out over the next n turns. Now, you might even carry this all the way up to infinity, if you wanted, if you figure that there's no particular date when you think that the firm's going to end, but periods very far into the future don't matter very much. We'll see why in a moment. Okay, so then, what's this? Over 1 plus r to the 1. 1 plus r to the 2. And all the way up to 1 plus r to the n. Okay, first of all, what's r? R is the real interest rate. So you're discounting future profits by the real interest rate. So, and more specifically, let's suppose this is 5%. You'd say 1 plus 5%, so 105%. You divide profits in the next period by 105%. So this actually reduces the weight that you put on the profits. And the key insight here is that future cash is less valuable than present cash. That's because present cash, you can keep it and it'll still have the same value, but you also have the option of doing something else with it, of investing it somehow, of lending it, or using it to buy physical capital, or to invest in human capital. There's all sorts of things you can do with cash if you have it now, which will generate higher value in the future. Some of them are risky, but there's potential for a big upside. Some of them are safer, but in any case, you've got a lot of things you can do with it. So you value the present cash more. So the future cash flows, you're going to discount them. And the further in the future they are, the more you're going to discount them. So if the real interest rate is r, in the second period you can earn another r on your, that much extra on your capital, so you discount this value stream even more. You get up to here, 1 plus r to the n, so you're taking this future profit and you're discounting it a lot, because that's cash that's far in the future. That's worth a lot less than present cash. And note, this is true, by the way, even if you personally are completely indifferent between whether you get your money now or later. Even if it's a subjective matter, you don't care, then you do care, because you can earn something on the money. So you could actually get more money if you had the money now. Now if this n is big, this could be a really big discounting. You could be discounting this future stream, especially if r is high and n is large, you could be discounting future profits a lot. And that's why, in a sense, we don't need to take this to infinity, even though typically if you're making decisions for a firm, you're not particularly planning to sell the firm at any given point, so it may be that, in a sense, the firm's expected profit stream does go on forever, but the really, really far future is not going to be that important. So there's not a big difference between this and, if you were to carry this on to infinity. Anyway, so this is present value. This is the concept of present value. It's an important concept to absorb and internalize and be able to apply accurately, both in this course and in being a manager or an administrator in any kind of an organization. Okay, now this just breaks it down a little further. So we got the summation sign. By the way, the summation sign I think people sometimes find scary. This is just showing you what the summation sign is doing. So here we have 1, 1, 2, 2, n, n. Now here we have t, t. We put a variable in here, and then the variable goes over 1 to n, and then we sum all of those things. So that's what this particular sign means, summation. Okay. So here we have the same thing. We've got the summation, and that's the value of the firm, is the present value of all the future profit streams. You note that if, well, actually I'll expand, break this down. Profit is total revenue minus total cost. That's the definition of profit. It's after you've covered your cost, how much revenue do you have left over? That revenue then becomes profit. And you notice that, let's suppose a firm is expecting to have a whole lot of revenue over the long run future, but it's also going to have a lot of costs, and the costs are the same as the revenues. What's the firm worth? Nothing, because there's no profits. So you're indifferent to whether you own this firm or not. You wouldn't pay anything to own the firm because the costs that are involved in running it are the same as the revenues. And so it's profits that matters, it's revenues over and above costs. Now, that's only one theory of managerial behavior, and as I say, it's sort of an ideal case. There's another possibility is that firms, what they're really trying to do is maximize sales subject to the condition that they have an adequate rate of profit. So if you were willing to lower your prices so much that they're well below your costs, you could get a huge amount of sales, but you wouldn't be able to keep running because you're not making enough profit. But according to this theory, then firms are just going for maximizing their sales subject to this as a constraint. They have to make sure that they make an adequate rate of profit, but they're not necessarily determined whether the profits are maximized. What they're really trying to maximize is sales. Not very easy to tell which of these is actually what firms are doing just by looking at their behavior, but a lot of economists have tried, and so some of them think. Notice that profit maximization might be a little bit harder to find. I mean, to know whether a firm is maximizing profits, you'd have to really know what all their options were and what the profits would be that would result under all the different possible decisions they could make, and that's pretty hard to do. So, but anyway, so this is an alternative theory. But that one criticism you can make as well. If this is the real reason, somebody who wants to make some money could just go out and buy one of these firms that's maximizing sales, and they could adopt different strategies that would maximize profits, and they'd make money. So why would this be sustainable? So that's part of this debate over how firms behave. Okay, principal agent problem. Now, this is what I talked about a moment ago. Why does the manager really want to maximize the profits of the firm? I mean, he's got his own objectives, right? Maybe he just wants to be lazy, not work that hard, or maybe he wants to improve his own reputation or build himself sort of an empire and get a lot of power, even if it doesn't maximize profits. Oh, by the way, this is misspelled. Sorry about that. It's not principal, L-E, but principal, A-L. Sorry, I just noticed that. Okay. So, and satisficing behavior is another concept in sort of behavioral theory. It's the idea that people just try to do well enough. So maybe managers say, that's okay, we don't know whether we're maximizing profits or not. That's just too difficult to figure out whether we're really maximizing profits. But, we're making some profit, our investors aren't too mad, we've got a little bit of reserves, we can keep paying our employees, good enough. We'll just settle for that. So that's another theory. Okay, so, definitions of profit. Well, we already defined profit as revenue minus cost, but that begs the question because there can be different kinds of cost as well. So, in particular, there is a distinction we want to make between business profit and accounting profit. So business profit, oh sorry, not between business, it's between business or accounting profit on the one hand, those are two different terms for the same thing, and economic profit on the other hand. So, so business profit, then you just take into account the explicit costs. Revenue minus the explicit costs. For economic profit, you also want to take into account the implicit costs involved in production. In some cases, then maybe there'd be an issue of how you treat investment too, might make a distinction between. Economic profit is supposed to be a more sophisticated, in a sense, a more accurate concept. You know, what you'd really want to maximize is economic profit, not business or accounting profit. But economic profit is much more difficult to calculate because you have to sort of figure out what are all the implicit costs of production. So, for example, let's suppose you have an employee who you're paying him $60,000, but he's really worth $200,000. You could put him on a lot of different projects on which he would, generate $200,000, for the firm. Well, his explicit cost is $60,000, but his implicit cost might be $200,000. So if you're going to look at a particular project, that's how you'd want to cost his time in order to really make the best decision. So opportunity cost, implicit value of a resource in its best alternative use. And this is a concept with very general applicability. I just graded a bunch of undergraduate final exams, and one of the questions was apply a course concept to an everyday situation. And some students did pretty well by saying opportunity cost. It's easy to come up with lots of examples. Like, well, I got up this morning and I hit the snooze button on my alarm clock, and that meant I got 10 minutes more sleep, which felt really good. But the opportunity cost was that I didn't get to do as much studying for my exam at noon or whatever. And so opportunity cost, anything you do, typically it's going to use some resources. Resource is a very general term. It could mean time, it could mean capital, it could mean employees, it could mean social capital, it could mean, contact. So you've got a useful contact. He's only got a certain amount of patience to help you out. Maybe you're trading favors with him. That could be a resource too. There's all sorts of resources here, and so and all of them will have an opportunity cost. So you have to take that into account in decision making. Now, different theories of profit. First of all, why do we need a theory of profit? Well, I guess you could say, well, we want to explain as much of the world as we can. Profit is one of the things in the world, so we want to try to explain it. Yes, but it's a little bit more mysterious than that, because economists tend to stress that competition tends to eliminate profit. So if there's profits being earned in some industry, then other firms should come in and want to compete in order to capture some of those profits, but as they do this, they'll actually end up eliminating the profits. So a theory of profit, in a sense, is a theory of why that doesn't happen, or at least it doesn't happen so completely that it totally eliminates profits from the economy. So one theory is risk-bearing theories of profit. So what this says is that, the reason why some types of businesses are making more than others, or some particular firms are making more than others, is because they're pursuing riskier strategies. And investors have to be compensated for that risk. That risk isn't always going to be easily observable. I mean, you can observe the volatility of asset prices, but you can't necessarily observe what the risk is on any particular project, or for a privately owned firm, or even for public companies. So just observing volatility of stock prices can be problematic. So bonds, it's often not that easy to see how much really risk is really there. So risk-bearing theories of profit would say it's the reason you see differences in profit among industries and firms is that the ones that bear more risk are earning higher returns. Another theory, frictional theory of profit. So this you could say, well, okay, maybe there's profits being earned in a particular industry. It would be a good thing for other firms to jump in there and try to take away some of those profits, but it takes them a while to do that. They have to form a strategy, they have to try to raise their brand name, they have to acquire certain kinds of expertise, they have to do a little bit of research and design to develop a product that's suitable, that doesn't infringe patents or trademarks or whatever. And so it's going to be a little bit of a challenge for other firms to replicate what the firms inside the industry are doing, and in the meantime, the firms inside the industry can earn profits. So that's another theory. Monopoly theory of profit, that's the idea that, well, clearly if you're the only seller of something, you can earn profit. There's actually a good theory of that. We'll explain that later on. Now, well, nobody disputes that if you are a monopolist, you should be able to earn profit, or at least if you're a protected monopolist. I guess that statement actually needs to be qualified a little bit, but never mind. But the monopoly theory of profit would be, say, well, this is actually kind of widespread, that there's industries where there's just kind of subtle barriers to entry, so that the firms that are on the inside, they kind of enjoy a certain degree of monopoly, and so they can earn profits based on that. Innovation theory of profit is that you come up with a new product. For a while, you're the only one who knows how to do it, so you can earn profits temporarily until other people imitate you. Or if you have a patent, you can earn them until the patent expires. Managerial efficiency theory of profit. This is the idea that some managers are smarter than others, and so the smartest managers, if the marginal manager earns zero profit, then the smartest manager should be able to earn more. So those are all different theories of profit, and they're probably all true in different contexts, so it's not really an either-or situation. It's just things to look out for why certain industries might exhibit more profits. From society's point of view, profit signals what the best way is to allocate resources. So if firms in a particular business are earning a lot of profits, that means they should probably expand production, and also that it's worthwhile for other firms to jump into that business. Basically, there should be more investment. You should produce more of whatever good it is that's generating so many profits. And investors will respond to that, and that's socially beneficial because society is exhibiting a high demand for those products. So high profits mean buyers want more of what the industry produces. Low profits mean buyers want less, or at least they're not willing to pay very much for what the industry produces. They're not willing to pay enough to cover the costs. So when you have losses going on, well, then firms are not going to invest. They might keep using their capital until it expires, or maybe they'll look for ways even to repurpose their capital. You might see some exit, or you might just see investment dying off. But over time, then the industry will adjust and will have a lower capacity that reflects the lower level of demand. Okay. Business ethics. We won't get into this much in this course. It's not the topic of the course, but it deserves a mention. This will identify certain types of behavior that businesses shouldn't engage in, employees shouldn't engage in. This will tend to go beyond enforceable laws. So a lot of things may be contrary to business ethics, which are not actually illegal, or which it's a little bit unclear whether they're illegal or not. For example, I think in the newspaper business, then there may be a norm that that whoever scooped the story, you'll give them credit for being the first to get the story. Maybe you couldn't really force you to do that, but that'll be a norm that develops. And it could be beneficial because then when you get the first story, then other people will credit it to you, and so then it creates incentives for everybody to do better. But this is something to bear in mind. Okay, another thing, changing environment. So first of all, globalization. Second, technological change. These are big sources of change in how managers do business. So globalization, that's an increase in international trade. So goods and services moving internationally, but also capital is invested across borders. That happens a lot now, both in the form of portfolio investment and foreign direct investment. Technology, a lot of times the best technologies may be from somewhere else, or if you have the best technologies, it may be that you'll do better to use them globally rather than just selling them within the country. I mean, if you create the best smartphone, you want to sell it worldwide, not just where you live. and then skilled labor, particularly, and actually unskilled labor too to some extent, but particularly skilled labor tends to be recruited across international frontiers. So technological change, so telecoms and the internet are the biggest areas where we're seeing just big changes in how managers do business. I mean, there's been also big changes in hydraulic fracturing, so in methods of extracting oil and gas. That's had an important impact on the economy, but it's not nearly as comprehensive in its impact. That just basically changes the price of a particular natural resource. But with the internet, it means a whole new way of doing business for many, many industries. Okay, so just getting a little bit of a feel for globalization. So this lists a bunch of companies, shows total sales, foreign assets. You know, they're ranked. These are major companies ranked in order of the quantity of their sales that are foreign. So Ford Motor Company, for example, over 50% of its sales abroad. Honda, 82.9% of its sales abroad. Some of these are oil companies, but then we've got oil companies. Hewlett-Packard, 66.6% of its sales abroad, so the technology company there. Siemens, kind of engineering and heavy equipment and stuff, I think is their specialty. Carrefour, supermarkets. So all these firms are actually relying more on global markets for their demand than on domestic markets, and so clearly you'd have to have a little different mindset. Couldn't afford to be myopic if you're working for a company like that. So most admired companies, I was struck by this in that so many of them are American, but that may just reflect that America is sort of the single biggest. If you conducted the survey in Germany, it would probably be a lot more German firms. But if you do it internationally, there's no particular country that is as prominent as America. But so these are globally admired companies, mostly based in the United States, but some foreign. And okay, that's enough for chapter 1, I think. And so we'll go on to chapter 2.